Yeah, longer, but okay, don't worry about it. We throw them now.
Okay.
All right, bye.
Cool.
All right, we'll start again. Access to this webinar is for educational informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in any webinar, website, or promotional material may constitute a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur. As a result of the information discussed in the media identified above, by accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone, unlike Facebook. So, where are we? We are bouncing again, as usual. Bouncy. So let's see, we are coming back. We didn't. Now, this is kind of making a progress, because if we get back over the lines now, we have to take it more seriously. So if we get to those weak bounce lines, and 2880 is the bounce line here, we get back to the weak bounce line and come over it. We take it more seriously this time because we certainly fell less. We didn't retrace all the way back to the bottom. So in fact, you can even argue that 2850 kind of held up this time, which is our midpoint. So we went below 2850, although we still use 2850 for the midpoint, because we don't care if you overshoot. You know, that's an overshoot, but the overshoot was within the bounds that you'd expect. It was almost the same as a weak bounce. You know, since 2850 is the midpoint, then 30 points below that is 60 points below that is 2790, which is basically this line over here. So it's just a 20% overshoot, the same way we expect a 20% bounce. So then you can get a symmetrical move. If you overshot 20% below, you can get a symmetrical move 20% above, which is what the Fed says they look for, right? The symmetry of the move in interest rates. And then that still means you're hovering around that 2850 line. So if we go below 20 and above 20 and come back to 2850, it doesn't resolve anything. It just means you have to keep watching to see what happens. So unfortunately, after these big exciting dips, you end up with a lot of waiting around doing nothing, because you have to wait until we see this trend change. See this trend of like declining? These are the pivot points, and every day they get lower and lower and lower. And now the bounds is stretching, so you're actually in danger of a much bigger move. Could go up though, but you're in danger of a much bigger move as these pivot points are stretching out. So we could get a really big move in one direction or the other. And, you know, so far, we get that a bad up, weak demand at the $27 billion 10-year auction. So the 10-year note auction just went badly. And there's not a lot of demand for the notes, which causes the rates to go higher if there's not a lot of demand for the notes. And we'll look at that in a minute. So anyway, so there's still plenty of bad stuff, but we just, you know, it's bad to have an opinion right now. You just want to watch and see what happens. So if we go over the weak bounce line, we can't get more bearish. If we go to the strong bounce line, you have to then just wait until we clear the strong bounce line to start positioning ourselves back to a bit more bullish than we are. Because right now we're pretty much neutral, but kind of pushing a little bit bearish at the moment. Wow, look at silver catching up to gold. That's crazy. But you see, you know, honestly, if this trend right here, these lower and lower and lower and lower and lower support lines, right? They keep falling. So your support keeps falling. That's not really bullish. And 29.10 is a strong bounce line. That's another trick, by the way. If you start seeing, if this top support line here, resistance line at this point, if this resistance line comes down to 29.10, which you know is your strong bounce, then you know you're in big trouble, because that means that the strong bounce is getting above the top of the range. That means you could be moving into a whole new lower range. But still, at the moment, we stopped right there, and that means we fell a lot less today than we did the other day. And that's how you consolidate and strengthen. So it's possible that we're going to just end up with this weak sort of pullback off of that terrible, terrible news, which is amazing. I can't believe how little of a pullback we're getting, really. But what can you do? I mean, it's, you got Trump and you got the Fed, and everybody's rushing around trying to support things, and look, the main reason we're down is over a stupid trade thing with China, which you could fix in 5 minutes. That's the danger for the bears, really. Is how do you bet heavily against a market when all they have to do is tomorrow just say, oh, we made a deal with China, end of story. It's all over. Is the economy weak? Earnings are kind of weak, but not terrible. The Brexit thing is still happening, but it doesn't really matter for the next for 90 days. But then it's going to be a disaster in October. Iran. Who even remembers that we're basically going to war with Iran? That's like just that fell by the wayside. Trump being impeached is still in progress, but also nobody cares. Nobody is. Yeah, I think that's a good strategy by Trump, though. He just causes more and more crises until you can't even remember what the original, like, what were we worried about a month ago? It's hard to even remember. You have to go back and say, oh, what on earth were we worried about? Like even last week. I was just looking at it because of the webinar. Last week, before all this crap happened on Wednesday, we were expecting the rate cut to keep the S&P above 3,000. And it did for the day. Then later that day, Trump went crazy on China. And then took away the whole point, or not disconnected. It's very likely that Trump was waiting for the Fed cuts so he could, he was told that if he was told logically, he was told, you don't know what he's really doing because he's crazy, but logically, somebody told the president, if you put more tariffs on China, the market's going to drop 1,000 points. So Trump says, well, before we do that, we better get the Fed to cut rates so the market will be pushed up 1,000 points, and then it'll end up being neutral. And that's effectively what we're doing here. We're kind of, we strongly mitigated. Well, the tariffs mitigated the rise from the Fed, because the Fed started rising this first, and then the tariffs hit. It's all crazy, though. It is really the most insane freaking thing. Thank God we are running portfolios that are miles ahead, because it's a crazy thing. And I honestly, I still wish we went to cash, because I would have, even though we would have went to cash at a lower price than we're at now, but I would have felt better being in cash. I still don't like where we are. I don't like what's going on. I don't have a clear vision of what to be investing in right now based on what's going on. It doesn't make me comfortable. And I wanted to sell in May and go away. This is, we talked about cashing out here. That's higher than we are now. Because we bet both sides and because we sell a lot of premium, we're still ahead of the game from where we were in May. But I don't think it's worth the hassle. I don't think it's worth the worry. We try to keep, we try to keep even our portfolios. I have the hedge fund, and we're trying to keep even in the hedge fund and stay good. We're still cranking out 5% a month in the hedge fund too, but it's stressful. The fund is up like 45-50% for the year. It's stressful though to keep going. It's like 45-50% is a good year. Why can't we just close it down and be quiet? It's like instead we have to sit there every day going over every position, going, what do we do? What do we do? It's you know, and it's a tough environment to make these decisions. So this doesn't go back far enough. So you have to look at so back, you know, back here, so the more, you know, the Fed did their thing whenever they did it in July, and was it July? Am I confusing my dates? This is July 31st. Yeah. So the last day of July. So, you know, we had the Fed came in, but the same time, the same day the Fed came in, Trump did his thing and wrecked it. And so instead of staying above 3,000, we actually fell, and now we're falling. And here we are. I mean, this is like, is this accurate for today? 2865. Is that what the S&P is at? No, it's actually 2860. All right. But anyway, so this is what's been happening, and here we are looking at it's psychologically amazing because the market is down 200 points. And we were like, oh, that's not so bad, only 200. because after this, 200 points down, it's like, oh, it's flowing, it's okay. But I think what we're doing really, though, is basically bouncing off even though we haven't hit it yet, we're bouncing off the 200-day moving average. And, you know, as I said, we decided 2850 was the midpoint to the drop, not the floor. 2850 is what we think is the midpoint to the drop, where we expect some consolidation before there's a move lower. The consolidation would be staying under the weak bounce line of 2880, and we're consolidating, and that would be consolidating for a move down. If we stay under 2880, we're consolidating for a move lower. Same way you have to consolidate for a move higher, like this. See, consolidating for a move higher. This is consolidating for a move lower, probably. Okay, can't be sure, but I feel that that's the case. I think that what we're going to see here is a kind of an M that brings us back down to at least here. Okay, you know, let's throw this spike out and say this was silly, right? So that means that we are moving along the 200-day moving average, and now we're going to go a little bit below, hopefully hold that line, and then kind of work our way back up to the 200-day moving average. And if we can hold that, that's great, though. Okay, consolidating for 2 years along the 200-day moving average around 2,800 is exactly what we thought we would do. That's why we never moved the average on the big chart. Where is the big chart? That's why for a long time we never touched the averages on the big chart. The S&P must-hold line, here you see the must-hold line is 2,600, because 2850, 2860 here, but 2850 is not bearish. Okay, 2860 is 10% over the must-hold line. Below the must-hold line is bearish, and it would seem catastrophic now because we're up so much, but it really is great progress. 2600, looking on the much bigger chart, this line is below this line is bearish. Above this line, we're just consolidating at a higher level. You know, people, you're just not used to failing anymore. That's 20% below 3,000. Goes back to 2,600. And then if we consolidate between 2,600 and 3,000 for a while, and then we make a move up towards 4,000, everything's great. But the problem is people are now used to or now expecting to make 10, 20% every single year in the market. Like, oh, how can the market not go up 10%? That's crazy. That's not what markets do. That's not what the global economy does. Think about it this way: the entire global economy averages less than 3% GDP growth. Okay, China, the king of the global economy, 7.5%, 7%, 6.5% GDP growth. They're the top of the global economy. So if nothing in the world is growing more than 6.5%, why would the market grow more than 6.5%? Where is the market? Does it exist outside the global economy? Or are we trading with other planets? No, it's ridiculous. Something is wrong. When the markets grow faster than the entire global economy for a sustained period of time, something is wrong. And it's not the global economy. Something is wrong. So one of two things has to happen. Either you have to look at the global economy and say, oops, I guess the global economy is growing much faster than we thought. That's not true because it's very easy to measure this. There's actual many different ways to measure the global economy that all say, no, this is how much the global economy grows. So then the problem has to be with the market. If the global economy is what it is, then the market growing way ahead of the global economy has to be the problem. And if there's going to be a correction, it's not going to be the global economy suddenly jumping up 20% to catch up to the market. That's not how it works. The stock market is, in fact, a very tiny part of the global economy. Okay, the valuation of the stock market isn't a tiny part of the global economy, but the earnings of the stock market are a tiny part of the global economy. Okay, we have a $85 trillion global economy, and the total earnings of all the corporations are $5 trillion maybe. So not even 10% of the global economy is corporate earnings. Then the corporations themselves have $100+ trillion valuation, but that's fine. It's got a PE. That's your PE of the economy. Basically, you're saying, we expect the global economy to continue for the next 10 years, and we expect companies to continue to earn money for the next 10 years, and we're willing to pay for that now. And that's the whole premise of the stock market. You expect your company to keep making money over time and pay you back for the money you're putting into the certificate. That's what it's all about. But you are currently in the market very much overpaying for the certificates that you're buying. And something has to correct. And it's not the global economy. That's the way it is. Now, Trump and the other central bankers are trying to correct the global economy. They're trying to push it higher and higher, but they're doing it based on debt, and that's not a real correction. Okay? You're not fixing your household economy by maxing out all your credit cards. That doesn't make you more prosperous. It makes you look more prosperous for a certain amount of time, but then it makes you bankrupt down the road. That's what we're doing. Consumer debt rocketing up, credit card debt, auto loan debt, and we talked about this last week, auto loan debt and student loan debt through the roof. That's what we're paying for it all with. We're borrowing tons of money, and then of course the federal debt and the government debt, all these debts, everything's piling up. And our government debt, $1 trillion, 5% of our GDP in 1 year in debt. Okay, forget the consumer debt. That's also does the same thing to the economy. But government debt just by itself, $1 trillion, 5% of the GDP. But we're only growing at 3%, the economy. So that means that the government has to borrow $1 trillion to get $600 billion worth of growth. That's inefficient. That's inefficient, dangerous, hard, whatever, blah, blah, blah. If the rates weren't this low, we would be in huge amounts of trouble. So I'm not happy. I'm not seeing, and by the way, this is making me more likely to cash out because I'm not seeing stocks that I'm excited about buying just because they're lower. There's not a lot of stuff I'm really salivating about as we get this tiny, this tiny correction so far, but there's not a lot of stuff I'm like, oh my God, I can finally buy this, I can finally buy that. Boeing, I don't want it. Lockheed Martin don't really want, we have these, but I'm saying, it's like, I don't really want it. There's not a lot of stuff I've been sitting here waiting for it to come lower. So we'll have to see, but I'm just this is not making me more confident. Let's put it that way. All right, let's see. So speaking of which, let's see how our portfolios are holding up. Portfolio. Wow. Oh, the options opportunity portfolio. Okay, so the options. I guess I can find it. Where are we? Home. Oh, that's a mid-year review. Keep that in mind. 2.1 million in the mid-year review. Did a July review just a week or two ago. Last weekend, wasn't it? So you have to reclassify it and do that. Continues. Oh, there it is. Okay, July portfolio review. There you go. So we were at 2.285 and Control F OOP. And the OOP was 336. So we were 236%. Okay, so honestly, 190 is not so good, huh? So the options opportunity portfolio is 290. It's down $40,000. All right, so the hedges, we're not at a point where the hedges have really kicked in yet, and we lost 20% of the portfolio basically. All right, now some of it will come back. A lot of it's because you have the higher VIX and we sell a lot of premium and it causes these fluctuations and such, but still keep it in mind, okay? It's like these are hard to protect when they're this big. Money talk. Control F, money. Oh, I write the word money a lot, don't I? Look at that, in the money. Wow, there it is. All right, money torque was 1112. Oh wait, no, we last reviewed it 1112, now 135. Okay, so 135 and money torque is now 121, so 14,000 down. All right, and that's also 20% because it's only a $50,000 portfolio. Who's next? There's money torque butterfly, 80% and Control F, butterfly. Oops, wow, there's a lot of T's. Butterfly, 184, 736. And here we're at 180, so barely, and as it should be, the butterfly portfolio, because it's very self-hedging, very little motion. Money talk hemp boca. Okay, hemp boca is down 8%, so that lost about 10% of its value also. And did we do the OLP? Yeah, we did. Okay, so we did those. All right, so now we got to get serious and look at the long-term portfolio. And these things are all up 100%, whatever, 200%. So it's not terrible, but it's just, you can't expect to not lose money when you have a sell-off like this. LTP. All right, so the long-term portfolio was, where is the number? 2285. Okay, it's not helping though. Oh, there's the number, 1547. All right, so we were at 1547, and now we're at 1301. So that's 250,000 less in the long-term portfolio. And then the short-term portfolio. Now, if it worked correctly, half of the loss should be mitigated by the short-term portfolio. So, Control F, STP. So it was 737, and now it is 824. So about $85,000 more here, partially mitigating a $250,000 loss. But again, it's very hard to be sure when things are in flux because the premiums are very high, the positions keep changing, the bid-ask spreads are not in your favor, so you have to be careful about what it looks like. The point is, it's more or less working, and we've been tracking it all week, so it's been pretty much where we expect. It's like, yeah, you're not going to not lose anything. Otherwise, what are your hedges for? We're generally bullish long term. So if we're generally bullish long term, when we have a correction, our long term portfolio is going to take a dip, but we expect it to come back. Now, our job at this point is to go through all these positions and look for ones. Is this a long-term portfolio? No. Our job in the long-term portfolio is to go through all these positions and oh, and by the way, the STP, the short-term portfolio was up like 50,000 more yesterday, but we didn't cash it out. Not yesterday, the day before yesterday, but we didn't cash it out because we didn't, we still want those hedges in place. We aren't ready to call a bottom yet, so it's another detriment to what we're doing. When we're ready, we're going to take the long positions in the long-term portfolio, like ones that we're willing to add to, like these $2 calls for CHK of 2021. So we might double down on these. Helios Matheson is dead, so we don't care. Here's the CAH. We might add the bull call spread to CAH. Anyone who's taken a big hit that we think is worth adding to. Intel, do we wish we had bought more Intel? I think we're good on that one. Apple, the short puts, well, no, that's okay. We don't want to add more short puts to Apple because we have a bigger position. So, we look for anything that's been particularly beaten up. Caterpillar is back to a level where you might want to add the bull call spread. Although, how much do we think China's going to be resolved in the next year or two? I don't know if it will be, so I might not want to add to Caterpillar. But we look at each position and figure it out. Has it gone low enough for us to want to double down? Frontier, we said we're going to double down. They're down to 96 cents now. So our average is 264. If we add another round at 96, we spend 38,000 more dollars on top of the 105 we spent. Makes it a very big position in the long-term portfolio. But it's a big speculative position that we said we're going to ride it out until the bitter end. So if we're going to ride it out, though, there's no sense in riding it out needing to get back to 264 when if we buy more at 96, that's 270, 380, that drops the basis down to 190. And then at 190, we can sell $2 puts if we want to, and the $2, these are $2 calls. And what, we can sell $2 calls also, but we can drop the basis another 40 cents. All right, so we have, it's like, then we can drop it to 150, and then at 150, you're almost in the ballpark. But we want to let it go for a couple of days and see what happens. We're not going to jump right into these things. Entercom just had a huge sell-off. I'm not sure that I'm ready to jump on more ETMs. We're already going to get assigned these ETMs. They're a small company, and they're a radio company, but they also are getting into the podcasting business, and they just bought 2 podcasters. And people are freaking out because they think they overpaid for them and they're draining their cash and so on and so forth. And if they're draining their cash to make acquisitions, are they going to keep paying their dividend? And it's a dividend-paying stock, so people are freaking out about that. Who else went significantly down on us? All right, so those puts, so we're going to get assigned those puts, so we don't have to worry about that, about doubling down. And meanwhile, though, it was a very small position. The whole position, 15. That in the long-term portfolio, this was nothing. We spent 15.3 minus 6, 7, so yeah, 9, about 8, about $9,000. This was a small entry on purpose. We wanted to see what would happen to them. They've gone down considerably. We're going to be assigned. That's not a question. So we're going to have more than 15.3. We'll have like 30,000 into the position now. I'm sorry, we started with 9, so we'll have 9 plus 16 is 25. We'll be 25,000 in, which is still nothing in the long-term portfolio. And if they keep paying the dividend, that's fine. And then we'll sell more. We made a lot of money on these calls, right? They're done, so we made all this money. We're going to sell those out. We're going to take a lower call, add to our position, so on and so forth. It's all fixable. It's all very easy to change. We just have to decide where we're going to put our firepower. But we have a lot of firepower because we have 646,000 in cash, and that's plus there's another 600,000 sitting in the short-term portfolio we're not even touching. So we can double down on every position we have. But still, it doesn't mean I want to. It means because until we get comfortable that the market is bottomed, we're not going to jump into these things. Apple is still Apple, so if we can improve it, we will, but there doesn't seem to be a lot there. Oh, the short calls, we actually probably should take advantage of this, though. We made money on the September calls, so we might want to consider taking some of that off the table. That's pretty good. We didn't really think we were going to get back to 190, and we did, so that's nice. ALB, I think, and some of these we have, or we already talked about adding to from the last thing. Best Buy is still cheap, BHC. Cheesecake Factory definitely would add to that one. Most of these are still winners. Oh, what happened to Chipotle? $7.89. Wow, they're back below 800. But we sold the 2020 740 calls for $76. So that's $820. And look at this. This is so unfair, right? We're below. You know, it's January calls. We're below 800. But we're still getting, we're below, you know, 820 is the net. Our net here is 820. So we're below that, quite a bit below that, but still we're showing a huge $30-something thousand loss. So think about it. All this has to do is stay flat, and these go from 98 to 50. So we would gain 50% of this amount, so $74,000. Would drop to our portfolio if these short calls go worthless. Meanwhile, we're in the money on our spread, so that's not a worry at all. This one's ridiculously in the money, so that's not an issue. CMG hasn't pulled back enough for us to sell more puts. These puts are ridiculously out of the money, so we're just waiting for time to tick by on these puts. But the one we really care about is these short 740 calls. And remember, again, time and again, I kept refusing to do anything other than just roll these along, because I said eventually we'll get to 740, and they still probably will. You know, so we're not going to do anything drastic, because right now these things are $75,000 better position than they look like they're in, and that right there makes up a lot of the losses we have in our portfolio. So. And I think I said that last week, right? I said, you know, you have to realize, I think we were down a lot more than this last week. Well, you can find that. There's a Control F, CMG. Nope, with CMG. Here I'm just talking about CMG. Okay. So at the time, you probably can't see this. Oh, no, I guess not. So at the time they were still down 120. So it hasn't actually changed from then. It just went up and then it went down. But either way, so the point is that these short calls are themselves a hedge. You know, I mean, that's a downside hedge, right? Because if the whole market goes down, those will probably expire worthless. We'll pick up $148,000. As I said, half of this money, $75,000 of this number is premium. So and it all expires in January, which is it's now August, so September, October, December. So basically four plus months, and we're there. Who else took a big hit? Nothing too bad. FCX we might want to add to, because it's still a small position. And see, it's really easy to see on the charts, because it's like, if you look, it's like, okay, so what do we spend to get in here? We're 20 minus 9 minus 7. Well, that's only about $5,000. Okay, so this is only a net $5,000 position. It's down 10, 11 minus 5. It's down 6,000. So we spent 5,000. It's down 6,000. If we double down on the position, then we have to spend how much to double down on this position? Just roughly, it's a credit right now. So if we double down on this position, we would actually collect more money. We'd still be down the same 6,000, but we have twice as much of an upside. And then what we have to say is this upside still realistic, or should we adjust it? If we adjust it, that's fine. We could roll this down to a lower spread. But you see the point, so we're scaling in, because we're scaling these positions, because we have a small initial input to the position. If we say, oh, FCX is only cheap because Trump ratcheted up the thing with China, and they'll get out of it eventually, and then we'll be happy to be a long-term holder of FCX, that's all great. Then this is our opportunity to do something about it, to add to the position. You don't squander the opportunity, and that's another reason why it's great to be hedged, because by hedging, we have the short-term portfolio making money while the long-term portfolio is losing money. We deploy the cash that we're making on the downside and put that into our upside positions. But again, this is only if you have a long-term bullish premise that you believe in. And I just said it would be easier to be in cash and not even worry about it, and only buy the things that we really like. But you know what it is? We've already purged this portfolio several times, and we're pretty much stuck with things that we really like. There's not too many positions in here that I would want to cut. Even like here's Kraft Heinz, right? And again, big loss, $18,000 loss, but these are, you know, our allocations in the long-term portfolio are $100,000 allocations. And so an $18,000 loss is a 20% loss of this allocation block, and we only netted in for 34 minus 8 is 26, 16. So we only netted in for $16,000, and the cost of doubling down, and again, I'm not saying you double down because we want to roll it, but the cost of doubling down is net $3,000, is a $3,000 credit to double down. And we'd have the same loss, but then we'd have this massive, massive upside if they ever recover. That's why this portfolio makes so much money, because look how easy it is to fix things. And why? Because we have sensible, generally sensible size positions. Now, if something gets worse and worse and worse and worse, you end up with like FTR, where we have a $100,000 position. That's a full allocation block in a position that's gone very badly against us. We're down about half on a full allocation block on FTR. But that's your worst case. And fortunately, because we are up, wait, let's see, we started at 500,000, now we have 1.3. So we're up 800,000. So we're up 8 full allocation blocks. So it's not unusual that we lose 1 or 2 along the way, but this portfolio is up 8 allocation blocks, and we have 1 allocation block that's a full loser, or a half loser actually. All right, who else? So, you know, and that was by choice. I mean, sometimes we chase something and it doesn't work out. And at the moment, it doesn't, FTR is very shaky, very, very shaky right now. Walgreens, here's another one. We have been adding to it, though. We are aggressively long on Walgreens. But still, 87 minus 19 minus 11 is minus 30, 57. It's 57,000. This is still half an allocation block. Half an allocation block is down $25,000 roughly. All right, $26,000, I'd say. And if we wanted to double down, it would be 55 minus 16 minus 8 is 24, is $30,000 to double down. We still wouldn't be at a full allocation block if we double down on Walgreens. We're not going to, though. We already have 80 longs and only, you know, I say double down, it doesn't mean really double down. It means that we would then probably spend money to roll the 5s. Let's say we roll the 50s down to the 40s for $5. That's $40,000 we spend there. But we collect some of it by selling short calls against it, and we collect 20,000 back, let's say, of that. So we're going to spend net $20,000 to roll 80 calls. We roll 80 calls down $10. That's an 80,000 potential upside, and we spend net 20,000 to have $80,000 more upside. And by the way, and that upside is in the money because Walgreens is at 50, and we're going to roll to the 40s. So the upside's in the money. It's not like it's out of the money. We're not wasting it unless Walgreens goes even lower. But that's true of any stock, right? If the stock goes lower, you have 8,000 shares, and you're going to lose $80,000. So the risk is still there, but we're buying our $80,000 for $20,000. We're buying at a tremendous discount, the new money, by lowering our cost basis on the spread. And again, all that's, oh wow, look at it, we're only down 85 now. All that is possible because we're taking advantage of these dips, and yes, you don't know when it's going to stop going down, but I do know I want to own Walgreens for the next 10 years. So therefore, anytime I can lower my strike $5, anytime I can lower my strike $10 for $5 cost, I want to do it. It doesn't matter if it's the perfect time. Now I know that the least you ever really see, unless you're way out of the money, but the least you ever see a roll of $10 is $3.50. So even if my timing is terrible, and even if Walgreens goes down significantly more, I'm only going to be overspending by $1.50, which is $12,000. So I'm risking $12,000 to pull the trigger now on my roll down. That's how much I'm risking. I'm risking $12,000 that I might have saved if I somehow amazingly timed it perfectly and Walgreens went down another 10% and I rolled then at $3.50 instead of $5 that I'm going to spend now. But you know what? I'm going to spend $5 now, and if it goes down 10% more, I'm going to spend another $5 and roll down again, and I'm going to have the Walgreens 2022 $30 calls. So with Walgreens at 50 right now, would I spend $80,000 more to be in the $30 calls, which would be $160,000 more in the money? Yeah, of course I would. It's not even a question, right? And so if I believe Walgreens value, and again, this is a problem with, you can't apply, TA doesn't work like this. You can't go by the chart, because if the chart says, oh, it might go low, of course it might go lower. But I look at Walgreens and say, they make this much money. They're going to continue to make this much money. They are worth this much. They have a certain brand appeal. They have the X many stores and have X amount of value. So I look at Walgreens and I see value to the company at $50. So I don't really care if it goes lower than $50, it's still worth 50. Same goes with like Macy's in the 20s. Macy's at 20 bucks is ridiculously low. So when it's down at 20 or if it's below 20, I'm excited to buy that. There are some things here I'm excited to buy. Look at Wheaton Precious Metals. That was killing us for a while, Wheaton Precious Metals. Now it's gone away. Now we're miles in the money. Now it's up at 27. Whirlpool also miles in the money. You know, it doesn't matter having a little dip here. In fact, actually, these short September 140s on Walgreens are now out of the money. This is what we do. We sell premium constantly, and this is what saves us. This is why we have so much cash. This is why when the market dips, it doesn't hurt us that badly. Or if it may hurt us, but not for the long term. And by the way, in the last dip, and we talked about this last time, in this dip, which was a full 20% correction, the long-term portfolio was down like 30%. That was a huge. I mean, we had some huge drops in our portfolios. One of I think Money Talk was down almost 40% from where it was topped out. That's why you have to decide. You have to decide at the top that you want to stick in a position. That's why, you know, I didn't want to really, but we're doing it because a lot of people want to see how we ride out the dips, even though we just did it. People want to see how we trade these portfolios in a bad market. This is how we're trading in a bad market. And Sandra says WBA is closing 200 stores nationwide. Okay, I read that yesterday, and I didn't even actually. I might have noted it in one of the news items, but the reality is I didn't consider it important at all because I know that that's out of I'd say 1,000 stores. Let's take a look. They have 244,000 employees. They have, oh, I'm sorry, 9,000 stores in the United States. 9,000, that's way more than I thought. 9,560 stores. So think about how irrelevant it is that they're closing 200 stores. It shouldn't even be news. That's the funny thing about it. Walgreens just merged with Boots, and they bought a bunch of Rite Aids. So of course they're going to cut something. You don't keep every single store open. They bought the whole thing, and they obviously got some stores after they do a review. They say, okay, these 200 are redundant or whatever. You know, I live in Florida now. Everything's redundant. I mean, every single Walgreens. If you know where a Walgreens is, then you know where a CVS is, because almost every time you see them, they're right next to each other. Like they literally are on the opposite corners almost everywhere you go. It just depends what side of the street you're on, whether you go to Walgreens or CVS. So anyway, so 200 out of 1,000. It's not even worth mentioning, really. It shouldn't even be an article. You know, and even more so because we know that Walgreens is in the process of restructuring, and they picked up these Rite Aid stores, and they're reviewing them, so they've only cut 200. I'm surprised it's only 200. I mean, honestly, if they would have cut 1,000 stores, it'd be like 10% of their stores, and you'd be like, oh, okay, that's something. But 200 stores is nothing. I just, to me, it's probably a first step. Whenever you get a news item, whenever you see something like that in the news, before you react to it, you always have to go and say, well, what does that mean really? You know, that's out of what? And that's the trick. You got to look at it and say, well, what are we really talking about here? What are the actual numbers? And you got to put it in perspective and proportion, and think about it, and also go back and think about, well, why would they be doing that? What have they been doing lately? What are their things? You know, what are their goals, or what do they say they were going to do? So there's nothing there that wasn't expected. But what it does is and this is where you take advantage of it, though. What it does is it scares people, and they freak out. Well, that's convenient. It was BA, now it's WBA. So that kind of article scares people, and they start selling. And then you say, well, okay, fine, at 50 bucks, I'm going to start buying. There's no fundamental change. Nothing changes in Walgreens because they've closed 100. So something changed. I bet. All right, first of all, they're going to take a hit because they're going to pay. They pay off leases that are, you know, they're going to write down leases and write down some impairments and so on and so forth in the restructuring, which Frontier just didn't got killed for. But it doesn't, it's part of their plan. You know, yeah, they're going to take some hits to the bottom line because they're closing all these stores, but that doesn't change anything. It doesn't impair their ability to earn money and move forward and so on and so forth. In fact, it improves it over time. They're closing some less profitable stores. But nobody's patient. Everybody just reacts to whatever the news is that day. And that's one of the big flaws in bot trading is these AI programs are trained to react to stuff like that. And this is really the kind of the problem with computer, you know, with AI-driven trading, is that these computers are so fast and they're always looking to react. And the thing is, the programmers are being told to program them to react quickly. The advantage of the computer is the ability to react quickly to news. So they're looking for things like that to react to. That's what they're doing. They're waiting all day. They're waiting all day long. Think about a computer, how fast it operates, and it has to sit there all day long staring at Walgreens, thinking about, like, well, nothing's happening. Finally, a news item comes over saying Walgreens closing 200 stores. So now the programmer, who has to report to Goldman Sachs' office and say, okay, well, you know, so here's the thing. The news comes in, it's negative news. Generally, when people are closing stores, that's a bad sign. So they say, well, in that case, we're gonna sell 2% of Walgreens, like that. That's what they'll do. And they're just making up a number, but they've got a formula. They say, okay, well, if this happens, then that. But they're not mitigating it with other factors. The computers don't really do that. They just read the headlines and they react to the headline. And they react instantly to the headline without ever going the next step and the next step and the next step. And that is often an advantage, but not always an advantage. And in a case like this, it's a disadvantage because they're making a mistake. And this is how the market is being driven these days. It's being driven by these fast-acting computer programs that send things flying up and down very, very quickly on very scanty evidence without stepping back and thinking about it. And again, the advantage of our system is we're hedged well, even within the thing that we have, we're hedged. So in other words, our Walgreens position is we have the $50 calls. We sold 40 of the $65 calls, not full covered, and we sold the $65 puts. So we're getting hit on the $50 calls, but the point is we're going to make money on these. We're going to make $19,000 on those. We're going to make $11,000 on the short puts as long as they don't go, as long as they don't stay too far below 65. And on the calls, like I said, we're going to roll them down and put ourselves in a better position. If they end up holding 50 and we roll the puts and we roll the calls and we sell some more short calls, we end up making money anyway over the long term. In the meantime, it's a short-term hit, but that's fine with us because it gives us a chance to build up a bigger position. We are hedging. We sold a lot of premium. We sold in this position, we sold 20,000. You know, the original cost of the position was 87 minus 30, so it's $57,000. So the 57,000 position in 1 year, we sold $30,000 worth of, we'll call it 2 years. So in 2 years, we sold $30,000 worth of premium against our 50,000 net position. So this year, in this cycle, we're going to end up down, what did I say, 36, 37, 27. So we'll end up down 27,000 in the first cycle. But in the second cycle, we'll sell another $30,000 worth of premium. And if we make that money back, then we're even here and we're still in for net $50,000. Then in the third cycle, we sell another 30,000. And if we get lucky in that cycle, then we make 30,000 against our 50,000, and then from that point forward, we have then we are net 20,000 in the position. Then the next cycle, if we sell another 30,000, now we've paid nothing. Now we have a net zero position, and we're still selling $30,000 per cycle. And cycles in this case being 2-year cycles. But that's what we build towards in the portfolios, especially long-term portfolio. We turn our positions into income-producing positions over time. And some of them, and some go bad, and some don't go bad. Some are very good. Some are a lot of positions. Of course, we've already cashed out a long-term portfolio. It's been 18 months already, so we've already cashed a lot of positions. But our net is that we're up 160. Wait, 160. We're up 160%. In 18 months. That's about 50% every 6 months. That's how much how much better could you want to do? And not everyone's a winner, of course not. Even in our top trades, we I think we come somewhere between, we're usually 70 to 80% accurate in our top trades. And if you're 70% accurate in the long-term portfolio and only 30% of losers, and you keep your allocation blocks rational, then yeah, you're going to lose some allocation blocks, $100,000, you're going to lose some allocation blocks. But if you're 70% successful and you have 20 allocation blocks, that means 14 are going to win and 7 are going to lose, basically. And if the 14 win 100,000, that's 1.4 million. If the 7 lose 100,000, that takes 7 away, and you're up $700,000. And guess what? We're up $800,000. Now, it's not exactly like that because we have a lot more smaller allocation blocks, and that's because not every position causes us to go to a full allocation block. If it goes straight up, we end up with a very small allocation that makes money. And it sucks because you say, I wish we bought more, but we didn't buy more. So what? What are you going to do about it? So ideally in long-term portfolio, the positions go down first, then they go up. But the problem is when they do go down, everybody freaks out that they go down. And they start going, oh my God, this went down and that went down and that went down. It's like, yeah, then we get a chance to buy more. That's how we get these big positions. You know, I mean, honestly, not many of these things are big. Ford, we're going to make bigger because Ford came down a bit. I wish we had more Ford. Great thing. We're not even losing on it, but I mean, it's like, why would I not want more Ford? Gilead, getting to a good price again. Now we have the $50 calls, we have the $65 shorts, so we're 100% of the money on this trade. But the puts got cheap, so we should look at it again and see if we can expand this position, make it bigger. You know, that's what you want to do. You just got to look at everyone and say, are we happy with this position? Is this where we want it to be? IMAX is down near the bottom, near the lower part of their channel. We want to add to that one. We love IMAX. How did IMAX get cheap again? What is wrong with people? Seriously? That just amazes me. It's clearly worth 25. Clearly worth 25. Anytime it's down here, it's a buy. You know, but I'm sick of recommending it. I mean, I'm sure if you go back in the top trade alerts, we've probably recently recommended IMAX because I always, whenever IMAX is down, I love IMAX. Let's see, top trades. Oh, Tangiers. Oh my God. That's like definitely one of the, oh, how are they? Do they have earnings? Yeah, that's KT. Yeah, oof, this is one of my favorites. Tangier Factory Outlets. What a stupidly low price thing. I was just talking to somebody who's, I was talking to a REIT manager. One of the guys who owns one of the big REITs. I forget which one though. And he asked me who the best acquisition target was, and I told him Tangiers. I said they're ridiculously underpriced. So we'll see what happens. I may have caused them to get bought out. What was I looking for? Top trades, right? Okay, top trades. Here's Ford. Okay, see, we just did Ford. IMAX. See, I knew it. So you know, I'm very consistent. It's like I say these things, and I say them over and over again. It's like I know I love IMAX. So IMAX we picked up down here, the $20 one. If people are going to keep giving these stocks away, you got to buy them. Apple was recently mentioned. Walgreens Boots was recently mentioned. Cleveland Cliffs is, look how cheap Cleveland Cliffs is again. June 14th. So we're below the June 14th line on Cleveland Cliffs. And again, it's a China thing. This is all, it's Trump. They were zooming along, and then boom, Trump says, we're never going to do a deal with China. That's all it is. There's nothing wrong with their business. Not only that, they don't sell to China. That's the funny thing. They're North American. They are in the unique position of being a North American steel provider or iron ore. They have so many advantages. It's such a good company to pick up down here. CPRI, we felt bottom, and they went a little lower, but they're still good. And Lockheed Martin is zooming up. They're doing too good. Restoration Hardware has gotten away from us. C and TLT. Oh, look at TLT. Holy crap. See, and that's one we can adjust in short some more too. Field Air has been doing good, so we can't do that. So anyway, so you can just always go by the top trades and see if anything got cheaper since we did the top trade report. Not hard. Plenty of things to buy. The question is whether it's worth holding on to the ones that we have, you know, and it's the problem with the long-term portfolio at this point is we have gone through several purges already, and we have gotten rid of so many positions that we thought were dangerous. And all these ones that we're left with are every single one I look at, I'm like, oh no, I really like that. Oh no, I can't get rid of that. That's too good. That's where we are now. All these positions are really, really good. Oh, Dave & Buster's, see, they can be improved upon. Here's Tangiers. No, wait, no, that's not. That's Skechers. That's Skechers. Where's this KT? Oh, they must be in the thing. Yeah, with the dividend stocks. No, they're not. Where are they? Ah. There they are. Like, don't tell me I don't have any Tangiers. So no, we actually went into earnings pretty aggressive here, but still it's not a big position. It's 34,500 net, and we're down $13,500 basically. So that's where we are. We don't really want to add. What we did is we aggressively sold puts. We sold the 1750 puts for 250, so that we're netting in for more at 15, and we're at 1569. So we already committed to doubling down, actually to tripling down. If they stay below $15, if they stay down around below 1750, we're going to buy more. So there's really nothing for us to do on Tangiers except for wait this one out and see what happens. if we, you always have to look, how much does it really improve our position? If we double down here at 1569, that makes 39.40. We basically drop the basis to about 20, right? 30, no, 37, sorry, to 18. So we're about $18, $19 basis if we do that from 22. So it's not really worth it. It's 10, 15% lower for the basis, but we don't have good calls to sell. The problem with the REIT is that the calls don't pay well because because of the dividends. You don't get a lot of money for the calls. So we're not looking to sell short calls here. Therefore, there's a limited advantage to us in dropping the basis. Oh, and these are only January. Oh, that's great. Okay, good. So these are January. So that means we get to sell those again. But I'll show you what I mean about the calls. SKT. So they pay a big dividend at SKT, but the problem is they only have short-term options. We sold the 1750 puts when the March are out already. I'm sure the March 1750s will be the other thing. Well, they're on the 1750s, but clearly we could roll the 1750s to the 17s for free. That's a free roll. It's the same price. So we can pick up 50 cents there just by going out 3 months. We could spend 50 cents and roll to the 16 puts. So drop it $1.50, almost 10% in strike for 50 cents. And again, we're not paying 50 cents. It's 50 cents out of the money that we already collected. We collected $2.50. So now we would have collected $2 on the 16 puts, and that's $14 when we go in. That's why we do this stuff. It's like, you look at these things and say, oh, no, we made a mistake. We shouldn't have sold those. That's not true at all because it's not a one-step operation. We sold them and the first step didn't work out. So we take the second step. And if the second step at 16 doesn't work out, we roll to the next quarter and drop it another $1. And if that doesn't work out, we go to the next quarter and do another $1. And before we know it, though, by the time we actually do double down, we're at like 13 bucks. And then we've got a significant thing. Then we're down to 25 total. So now we're down to $12.50, $13 average. That can't be right. 35 total. So then we'd be down to like a $17 average on Tangiers. Meanwhile, SKT. So meanwhile, while this is happening, we're collecting 35.5 dividend every quarter. We just got one. That's lowering our basis. That's with 2,000 shares. Is it 2,000 shares? With 2,000 shares, that's $700 a quarter we're collecting against this position. $2,800 a year. So even in this losing position, we're picking up $2,800 a year to mitigate this loss. And again, we own this position. So over time, as this basis drops and as we keep selling premium, we only have to get lucky once and we collect this entire $10,000. If we don't get lucky, we end up with a lower and lower strike, and eventually we'll end up with 6,000 shares, and then we'll be collecting, what was that number? Oh, my brain. 35. So 7,700. So then we'll be collecting $2,000 a quarter. All right, so if we do triple down, we'll be collecting $2,000 a quarter on the assignment. And that's $8,000 a year coming back on let's see, what do we say we're going to be at? $13 a share? No, I'm sorry, $17 a share. So 17 times 6 is God knows what. Where is it? So 17 times 6. Number one. 17 times 6, 102. So we have $102,000. We'd be collecting $8,000 a year back. So we're collecting 8% interest on $102,000. We sell some calls. Oh, I was going to say why the calls. Here's the problem with the calls. Look at these. We're at 1560, right? If we sell the 1750 calls, we only collect 60 cents. There's no point in doing it. If we sell the 16 calls from March, we get about $1.30. Now, $1.30 is nothing to sneeze at. That's almost 10% of the price. All right, so yeah, so we sell five, so let's say we sell half of that. Okay, it's not even a year's worth of time. That's only 250 days. But let's say we sell half, and we collect 50 cents. So we're collecting 5% there, and 10% on the dividends. Okay, so that's 15% back on our investment every year. That means in 6 years, we will have paid off the entire investment, and then we're just collecting the dividends. And what do you do in 6 years after you collect the dividends? I ran the math for this. I remember it was during the seminar, but I ran the math for this. And the point is, so if it takes you 6 years, you get $100,000 in. 6 years later, you collected back $100,000 in premiums and dividends, right? Then what do? That $100,000 you put back to work in another stock, but you're still collecting now the $8,000 a year. And again, now seeing without selling any puts or calls or anything, you're now collecting $8,000 a year on the first $102,000, but you got that back. You put another $102,000 into something. 6 years later, you get that back, but now you're collecting $8,000 on the first set and $8,000 on the second. Now you're getting $16,000 back because after 12 years on the $102,000, you put your $102,000 into something else, and 6 years later, 18 years from now, you're collecting now $24,000 a year in dividends. You got your $102,000 back again, and you do it again. And now 22 years from now, you're collecting $32,000 in dividends, and you got your $102,000 back. And by the way, though, at no time your cash is back, but now you have 4 sets of stock that are effectively, hopefully worth still around $100,000 each. You didn't lose the stock. You just stopped worrying about it. So now you have $400,000 worth of stock, $100,000 worth of cash, and you're collecting $32,000 a year in 22 years from now. That's how you retire. But you know what? It's freaking boring when you start, isn't it? Because when you start off, you're just collecting your 15% on the initial amount, and it doesn't seem like you're ever going to make any money. But 22 years from now, you're making back. You're making 30% interest on your $102,000 basically, and you've got $400,000 of stock sitting around, and you've got the $102,000 still in cash sitting around. That's a 22-year retirement plan. You just got to follow it. That's all. It's not hard though. It really isn't. All right, where are we? 212. How we do? Market's coming back nicely. Look at that. Green on the NASDAQ, green on the S&P, barely. Green on the Russell, teeny tiny red on the Dow. So all in all, it's not a good day. We're flat. You can't have a party about this. It's not fantastic, but it's better than what we started off with in the morning. Oil, things aren't good when oil goes down 5% a day, and that's because we had a big build in the inventory. We saw that at 10:30. Why does that say 5 o'clock? 60. What are these times? Oh, I see. It's a weird scale. This scale is this is a very different scale than my. Here's where the inventory report hit. So we had a big dip since the inventory report. That spike there. So basically, we were at like 52.50, and we fell all the way down to like 50.52. We saw that build this morning in the EIA. I guess we can look at the petroleum status report and see what the full story is. I don't know what it's going to tell us, but we'll see. All right, can I make this different size? Ridiculously big calculator. Oh, there we go. Okay. Oh, that's much better. That looks more like my normal calculator. Okay, I can work with that. So what did I just say? Oh yeah, petroleum status report. All right, Control ++. Okay, this is August 2nd, correct? Yes, that makes sense. All right, so oil, 2.4 million build, gasoline, 4.4 million build, and distillates, 1.5 million barrel build. That's terrible. You know, but that was bound to happen. You're bound to get a snapback. After the 2 weeks of draws, something had to give the other way. On the whole, we have a 10 million barrel build, 43 to 53. That means other oils had a build too. Other oils had a build of a couple of million barrels. Doesn't look like anything weird going on there. Export-wise, we exported the same amount as we exported last week. Production-wise, no change in production. No change in refinery activity. No change in product supply, production. Nothing at all. So nothing changed. What happened is, you know, you got to realize these aren't accurate counts, really. So 1 week they say, oh yeah, we drew down 10 million barrels of oil last week, or we drew down 15 million barrels, whatever the number was last week. Well, if you see, and that's what we talked about last week, when you see these numbers don't actually change from week to week, and you say, well, nothing changed here, nothing changed here, nothing changed here. So where did this come from? Was there a holiday? Was there any reason we would have to speak demand? No, there wasn't really. Well, then the reason is probably that there were barrels that were in transit, you know, going a tanker here, a tanker didn't deliver on there, or this didn't go here, or this shipped out, but it didn't get logged over there. There are things that happen in the course of moving all these barrels of oil around that just for the lack of a little checkbox or something like that on a certain date, if it got checked off tomorrow instead of today, it shifts the whole thing over. It's just the, because every day it's 21 million barrels per day. So you're talking about a half a day of fudging somewhere. So there could be a little more demand, but there's not 10 million barrels more demand in a week. So you say, well, then it's going to have to come back and swing the other way the next week or in 2 weeks. But it can't last very long that you have a huge discrepancy like that, unless you start seeing some very concrete demand numbers. You know, you would see it. You would see an uptick in driving, an uptick in hotel stays. Marriott, for example, you know, they had a week report. If Marriott has a week report, Marriott is basically half the hotels in America now. So if Marriott says, well, room occupancy isn't what we thought it was going to be, well, that means people aren't traveling. You can't avoid Marriott. Everything you say at is a Marriott, basically. It's Marriott, Hilton, and then barely any independents. So if you're traveling, you're probably in a Marriott or Hilton branded hotel. And so therefore, you know, it's like they know if you're traveling or not. It's not, it doesn't lie. And you know, Marriott's got Courtyard now, so they got the low end. They got I don't even know who they have anymore, but they have a lot of stuff. Yeah, let's take a look. Just so you're aware of what they are aware of. And there are certain things I pay attention to, like Marriott's occupancy. MasterCard has a thing called Spending Pulse that they tell you what's going on. Everybody's got MasterCard. If MasterCard tells you consumer demand is off, consumer demand is off. They know what they're talking about. They're not idiots. Marriott. So Marriott is now, this is crazy. All right, where are we? All right, Marriott, Ritz-Carlton, St. Regis, Sheraton, Delta, Marriott Executive, Marriott Vacation Club, Westin Renaissance. I'm looking for ones that are actually popular. Courtyard, Residency, and that's another one. Fairfield's another big one. I don't know what these are. I don't know what that is. Element. Actually, Elements are nice. Moxie. Okay, so anyway, so you know, so the big biggies are like Fairfield, Residency Inn, Courtyard, and of course regular Marriotts, and then Sheratons. Those are all the ones that are big. So you know, you obviously, and Westin, sorry. And so you know, you stay at these things all the time. These are the hotels you end up at. So when you see Marriott tell you that that the summer numbers didn't come in the way they thought they were coming, and then you say, well, then how could someone driving? Where would people be driving to? Is everybody camping? No, Winnebago doesn't say everybody's camping, so therefore something must be off, right? People aren't traveling as much as they thought. And if people aren't traveling as much as they thought, they're not using more fuel. Therefore, the huge drawdown numbers we have the last 2 weeks don't make any sense. So that's, you got to connect the dots when you're doing that. Now, we thought, 50, we thought yesterday 55 was going to be bouncy, and it wasn't. We barely bounced off of 55. So here we got like a little tiny blip up, but then it died. So, losing 55 and losing 60 on Brent especially was a very bad sign for oil in the first place. And today was like a nail in the coffin. But we saw that with the API report. In fact, we talked about whether RB was good, and I said RB could go diving much lower. And look at what RB did since yesterday. It's down 10 cents. That's a huge down move for gasoline. And I still don't see a reason to be bullish on it. And again, because I'm not seeing the numbers, I'm not seeing any confirmation of the economy, and all this uncertainty is being created. I don't see anything to really be bullish about. I don't see any reason to dump our hedges. I want to let this thing play out a little bit more. And that's where we're at. Let's see, nobody's got any questions? Okay, good. I'm gonna wrap this up shortly if you guys don't have any questions. What is that? Go to web. Oh, go to webinar, weird. Okay, oh, that must be this control panel. Okay, you guys can't see that. Oh, what else did I want to talk about? Okay, yeah, oh, I'm sorry, yeah, real important. Talk a little bit about the 5% rule, because that's very much in play right now. We were talking about that this morning. So look, as I said, 2850 is our baseline, right there, see? So from 2850, we have a strong bounce and a weak bounce. And the strong bounce, the weak bounce, and it's because we have a fall from 3,000 to 2850 is a 150-point fall. The retraces are 20% of that fall. You see how perfectly it did that? It overshoots. It doesn't, the lines aren't set in stone. That's one thing you have to really let go of the concept. It's not science. It's not even math. It's just it's an approximation of what happens. And why is the approximation? The 5% rule is based on my observation of computer trading programs, which my father wrote. So my father wrote some of these, not the ones that are being used now, but back in the 80s. My dad used to write these programs for Wall Street. He was a systems analyst, and he wrote some of the original trading programs, the automated trading programs. And everybody was trying to figure out how to make a bot that would outtrade the market, blah, blah, blah. And it's the same thing they do today. But the thing that I noticed is, you know me, I'm a humanist. I'm not a, so my job with I would go in and help my dad because I spoke banker and I spoke computer because of my dad. I knew enough about programming to be able to talk to the programmers, and I would translate between the computers and the bankers. And what I realized in having meetings, we went to everybody. We saw all the big guys. We saw all the trading things. We wrote programs for multiple trading houses. And they're all looking for an edge, and they're all trying to apply their own special formula and blah, blah, blah. But in the bottom line, there's always a guy who picks an arbitrary line, and they have a computer, and the computer's job is to kick in at a certain level, which each trading house thinks they have a formula that's going to beat everybody else, blah, 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 because they say, oh no, when it does this, we're going to do that, when this does that, we're going to do that, and at this level, we do that, and when there's this much of a pullback, we do that. Well, you know what? Everybody's doing that. It doesn't matter if one guy does it at 5%, one guy does it at 10%, one guy does it at 2%. It's all the same shit. It really is. And what happens though is because going back and forth between the guys between the traders who think they know what levels to set and the programmers who have to program it in, everybody is averaging and approximating and so on and so forth. Also, there's this incredible misconception with computers that there are no such thing as that there are random numbers. There's really no such thing as random numbers, which means every single random number generator they use is faulty because based on the premise that numbers are really random. But computers A random number generator is just a thing that generates a lot of numbers and then picks one randomly. But those numbers are based on certain programs also. Everything has to be programmed. The computer doesn't just, numbers don't come out of thin air. The computer has to make them based on a formula. And no matter how much you try to randomize the formula, it's still a formula. Anyway, so things tend to coalesce at certain points, and those certain points are generally 5% increments. And so what happens is, if one guy says here, I'm going to kick, if one guy says I'm going to do it on 2.5% pullback, and another guy says I'm going to do it on 1% pullback, another guy says I'll do it on 8% pullback, it still averages out to something. Those averages tend to be 5%, 2.5%, 1.25%. So those become the lines that we like to use for the 5% rule. And so what we're looking for here is that a certain correction, those corrections tend to be the 5% increments. When you get to the larger the increment gets, the more likely you are to have a turnaround. And that's because all these selling programs at 5% are going to run into quite a lot of buying programs that are automatic. So in other words, the guys who automatically sold here are going to automatically, there's other people who are automatically going to buy here because they were looking for this correction. They say, you know, and the same way we buy stuff, frankly, well, what do? We say, well, we're not going to buy, we're going to sell a put. And if we get to that level, then we're going to get in. That's what a lot of trading houses do. So there are bargain trading houses, there are momentum trading houses. It doesn't matter. They all coalesce at certain points. And those levels are not that hard to identify. And so when we get a shot to 3,000, we say the market's getting toppy based on fundamentals, not based on just because we're at 3,000, although 3,000 is significant. So it's a place we do expect to see it, and we look at the fundamentals, and so we might be a little bit inclined to think that it's not going to go higher based on the big 3,000 line, and we should at least get a pullback. And at first we didn't, and then we suddenly do. But the point is, we're at the 3,000 line. There's not much of a reason to go any higher. Any little thing could have triggered it, and it turned out to be Trump tweeting out his trade thingy. Despite the Fed doing what we wanted, basically. So the market starts going down. Now, how much is it going to go down? This is where the 5% rule is very useful. It's going to predict. So we say, well, how much is 5% of 3,000? Oh, by the way, very important part of the 5% rule is ignoring things that, you know, ignoring spikes, basically. These are spikes. So how much is 5% of 3,000? Well, that's easy. That's 2850. That's where that line came from. I didn't have to do a big calculation. 5% of 3,000 is 150, therefore 2850 is your 5% correction. Now, back to fundamentals. Is 5% enough of a correction based on where we are? No, it is not. We haven't seen the kind of volume and the kind of rallies that we would expect to hold the market up. Therefore, we think 2850 is a midpoint correction, and that we're going to go down to 10% correction, which is 2700, which is that line right there. That's where we expect to end up. From there, we could easily bounce back to 2850 and probably hold it. But in the meantime, at some point in the next couple of weeks, we expect to go down to 27,000 or 2,700, sorry. Now, the other indexes have already corrected 10%. We were looking at that this morning. So they've already hit their 10% numbers. The S&P did not. The S&P is being slower to correct. And now everybody's being bouncy and everybody's hanging out of their lines. That's great, fine. But like I said, we're probably consolidating for a move lower. Right now, the S&P is at 2870, lower than it was this morning. So we're consolidating down here. I don't give a crap that it went here, went here, went here. It's consolidating for a move lower. What's going to cause the move lower? I don't know. Somebody's going to tweet something, somebody will say something, something will break down, China will retaliate. Who knows? But there's a lot of things that could cause it. Also, if you look at see this RSI indicator, right? You see what happens here? You go down and down and down, you bottom, and what happens? Down, bounce, then the big down. So we're only here. You know, you are here basically right now. You're at the down and bounce. We're not at this yet. And that goes to this too. Look at this one, the Maytag. Notice how it goes. It goes down and it bottoms out way the frick down here before you're done. Where are we now? Look at this. This is way up here. You're not even close. You're only at the beginning. See this? You're only at the beginning of the downturn. So if you're a TA person, you got that to look at. But the 5% rule tells us where exactly we're going to bounce. That's how much you bounce. A 20% retrace of the drop is where you expect to have a weak bounce. A strong bounce, 40% retrace of the drop is right there. And if you fail to make the weak bounce line on the first day, we hit the weak bounce line on the first day, then you should be getting more short. We didn't do that. So now today we're failing on the second day to make. Now on the second day you should make the strong bounce line. If you're going to have a full recovery, you should expect to see the strong bounce line on the second day. We're certainly not hitting that unless something really crazy happens into the close. So probably we're consolidating below the weak bounce line for a move further down. That's where we're at now. And that's why we got to look and see, are we short enough? Is that short-term portfolio holding up? Are we ready to deal with the fact that the long-term portfolio is going to lose another 10, 15% on the way down to this 2,700 line? And are we willing to ride that out, or should we cash it now? You're talking about $100,000. No, not 100. I'm sorry. You're talking about $200,000. Are we ready to lose $200,000 in value in our portfolio just to hold on to the positions we have? Which is why I don't really understand why everybody's so reluctant to cash things out. I'm like, well, why not cash it out and not lose the money? That's my attitude. I'm like, I don't care. I can buy more positions later. I know it's a hassle, but it's like I'd rather close. It's a hassle, but if you're going to pay me to sit for one day closing all my positions out, and if I'm going to make $200,000 extra for my day's work, I'll put in the work. I don't mind. I'll do it. I don't know why people are so reluctant to do it. It's just so much easier to cash out. And mentally easier too, and you get to start with a clean slate and pick all brand new stocks. I mean, there's a lot of things I like about cashing out. But anyhow, so we're not cashing out mostly, but again, not by my choice, but mostly because people just want to see what we do with the portfolios as the market goes down. And also, I have to say, I would say no, I wouldn't do it if I thought we were going to have a catastrophic failure. I think the Fed has one more save in them. I think the Fed still can move and save the market from before we get past more like a 10% correction. I think the Fed's got one more action, but after that, I'm gone. If the Fed steps in again, starts lowering rates and starts doing weird stuff to boost the economy, and the other central banks start doing it, that is the road to ruin. That's the end of it. And I'm going to cash out and be pretty freaking bearish after that. Because we are just way overextended. And the answer is to get another credit card and extend it some more. That's not a good answer. So anyway, balance lines 2880. This is still red. And one thing I said, anything that happens between these lines is meaningless. So today we went lower, but we didn't hit 2850, did we? I don't think we did. No, not today. Oh, we did. I'm sorry. We did go below 2850 today. How can I do this so I can see things at the same time? That's not going to work. All right. So the Dow 2550. I'm sorry, 25.5, and we're back to 26 basically. And so the Dow pretty much nailed. So the Dow hit that line right there, weak, and now it's back to 26 strong. It hasn't done anything. It's in between. It doesn't matter what it did. All right, the NASDAQ. Oh, did that wrong. The NASDAQ 74 and back to 75.40 now. So, now we're over. See, now the NASDAQ actually improved, so we added a green box. It didn't go below, it didn't fail this line, and it went above. So we're going to add a green box there. So that's significant. That's actually not that bearish, is it? And then we look at the Russell finally, and the Russell 1475 and now 1500. So right between it, right? 1475 came down to that line. Now it's back to this line. So what's changed today? Nothing has changed except the NASDAQ turned green. That's it. The NASDAQ turned green. So we had one green box on the NASDAQ. Oops, hang on, sorry. My daughter. She's down here.
Hey.
Oh, hi, sweetie. What's up? Yeah. Okay, I'll see you about 4 o'clock-ish or so. About 4, let's say 4:30, okay? Yeah. I don't know where that is yet, so send me the address. All right. Okay, so so basically not much has happened, but we have added a green box. So if we've added a green box on the NASDAQ, that's telling us don't do anything bearish. We just gotta wait. It's not a huge indicator. We've only got one green box and we're right at that line. Assuming we finish there, 75.20. Where are we? 75.36. Looks like we should finish there. So assuming we finish there and we have one green box, there's nothing to turn bullish about, but it's certainly means don't be more bearish. Nothing has gotten weaker and we've gotten stronger and we've tested these lines. So we're right in this range. But my theory is we don't make it to here. We're not even, and especially if we don't make the S&P's weak bounce, if we don't take that back, that's the S&P is the most important. You have to give it a higher weighting than the other indexes because it's the large caps that's moving the rest of the market. Oh, also now when you also want to look on the S&P, is any particular thing holding something down or pushing it or NASDAQ? So with NASDAQ, it might be just Apple moving up. So here's Apple. Apple is up. No, it's not because Apple's only up about $1 today. So it's not Apple moving the NASDAQ. It's not driving it. Apple. NASDAQ's just doing a general little recovery here. But that was yesterday. It had the bigger recovery. But Apple was 187 yesterday morning, or I'm sorry, Monday night. So Monday night, Apple was 187. Now it's 197. It is up $10. $10 is 80 Dow points. So the Dow is up from 25,000 to 25,800. So 10% of the Dow's move is just Apple. You know, it's a big contributor. But still, you know, these are not terrible, but they're not great. And what we have to do is watch carefully. The NASDAQ is the only thing that's got a box. So if it fails 20 and the S&P doesn't make 80, then it's bad. If the S&P makes 80 and this thing holds above 20, above 520, then probably a bit of it, then you want to look and say we're probably going to make it to the strong bounce lines now to test those. All right, but fundamentally, I just don't see why we'd have such a great recovery so quickly. I mean, what changed? Well, you know, what happened? Nothing improved. The only thing you have is Trump putting more pressure on the Fed to cut, and everybody's saying, oh, the Fed might cut again. You know, or China's not devaluing the yuan as much as people thought. But you know what? 2 days ago, we didn't think, you know, on Friday when we were crashing, nobody thought that China was devaluing anything. That wasn't why the market was crashing. That was a news story they came up with over the weekend. And that's the problem, is they throw a lot of crap at you to try to tell you like, oh, no, we sold off because of this and we sold off because of that. They want to tell you they sold off for any other reason other than not. Who tells you that we sold off because everything's overvalued? They don't say that in the media. Everything's sold off because stocks are stupidly priced. That's why everything's sold off, because it takes the tiniest touch to topple a house of cards. That's why everything sells off. Everything has to go perfectly to maintain these prices. But like I said, you know, this is extremely likely we're going down another 5%. It's not even a tragedy though. It's just a small correction. You know, in the grand scheme of things, that's not a big deal, but it's going, you know, it's going to happen, I think. So just be prepared for that. What else did we talk about? That was good. That's good. No, that was it. That was the important stuff. And the dollar, is this automatically updated? Probably is. Let me see. All right, it's 97.37 there. If I update this thing, 97.31. Did that change? Now I'm hallucinating. Did that actually change? Gold is 15.15. Dollar is 97.30. Well, that is where it is. Okay. So, you know, gold is still way up. Oh, yeah, are we still panicking? So, are we still panicking? Where's the VIX? VIX. Damn it. Futures, here we go. So the VIX is still up at 20, still panicky. These guys are basically flatlining for the day. You're flatlining also. Everybody's flatlining. Nobody's excited here. The dollar flatlining. So we're in sort of a holding period. Everything is waiting. And that means nothing's really changing. So you got to keep your eye on the fundamentals and see what's justified. But right now, everything's just drifting along. But people are plowing money into metals. They're trying to get out of the dollars. Coffee's coming up a bit. Sugar's, wow, look at sugar's crashing. The bonds came off their highs because of that bad note sale that we just talked about before. Wow, look at the volume too. Wow. So people really thought twice about it at this level. You know, you can run the 10-year note up to that level, but then nobody's going to buy it at the bond sale. They're not going to pay that kind of money. That's what it's about. It's about you saying, I'm only going to give you 2% interest on a 10-year note, and the people you're trying to sell the notes to at the auction, like, well, screw you, we're not going to buy them. And then the Fed who's selling the notes at the auction has to go, okay, how about it's an auction? How about 2.1%? How about 2.2%? They've got to sell them. They are going to sell $30 billion worth of notes. So somebody's got to buy them, and then they're going to have to keep raising their interest rate offer. That's the variable here, is how much rate they'll pay you to borrow this money, to lend this money. And that's the variable of the auction. So if you have a bad auction, it means you had to bid up the interest rates quite a lot at the auction. And what that tells you is that the Fed is underpricing what they can sell notes for. And this government is borrowing money like crazy. That's where the reality hits the Fed. You can make up any discount rate you want, but the reality is when you have to go to an auction and sell notes, somebody's got to buy your money. Greece didn't have their central bank raise interest rates from 4% to 21%. No, foreign investors told them, we're not going to buy your notes anymore unless you pay us 21% because you are a risky ass country. And that's how Greece fell apart very, very quickly. This country is looking riskier and riskier every day to foreign investors. You got to take these note auctions very seriously. If a 30-year note goes as bad as a 10-year note did, we got a problem. This was a bad sale today. And you're seeing it reflected there. And that oil thing, that's not good either. That's, you know, it's not good for the, that sector hasn't come back yet. You know, we're going up despite that, but if oil prices stay down, then the energy sector is going to pull back again, and that's going to be a mess. So still a lot of caution, basically. Oh, now people are asking questions. Any thoughts on why Signet was hit hard today? I haven't been able to find any particular news. No news. They didn't have earnings or nothing. Sig. Lab-grown diamonds. I mean, that's a, you know, that's, it's not really terrible for the jewelers because they're going to sell the lab-grown diamonds. But right now, I think that they're sort of the jewelers are kind of like sticking with the De Beers people and saying, "Oh no, that's not a real diamond." They're not pushing those diamonds. But eventually, they'll realize that those diamonds are going to help them move jewelry, and that's going to win out. The timing of their release and conference call, September 5th. No, that's weird. I don't know why they fell 5%. I don't see anything here about that. Their upcoming dividend, how much is their dividend? Oh, that's a big dividend, isn't it? Wow. Seriously? About 48? I didn't realize that. We might have to convert. Now, I don't see anything current on why Signet dropped like that, and the earnings are not until September. It's a long time. I do like them, though. I like them to hold on. But again, they're having a rough patch. You know, we like retailers when they're having a rough patch, but it's a multi-year trade, and everybody gets very upset about it when they don't go well the first year. It's like, well, how's it gonna? Who expected it to? FTR, free cash flow, looks like it's decreasing. What do you think on this? I know you mentioned selling a call at some point. Can you review your plan? Look, our plan for FTR at the moment is to wait and see how bad it gets. It could go a lot lower. People are freaking out about them. They don't think they're going to be a going concern. They do have free cash flow. They did actually make money. They're only holding a buck. That's good. You know, they lowered their guidance, but the bottom line is they have a net loss of $5 billion, lost $51 per share. But they took a goodwill charge of $5.4 million. So, in other words, they made excuse me. I'm saying it's not a lot. It is a lot. They made $100 million or $130 million they made, other than this impairment charge, which doesn't affect their cash. Okay, I don't understand how people. A goodwill impairment charge is not a cash event, okay? They sold off, here's what they did. They sold off a division, or a couple of states. They sold off a couple of states for $1.3 billion. Now, those states had a goodwill thing to them because they were saying forward goodwill on having this business and going forward and blah, blah, blah. So they expected over the years to make $5 billion on these states. Now they're not going to because they don't have them anymore. And they're also accordingly, based on that evaluation, writing down what the rest of their business to match and say, okay, well, if that's what we got for that, then that's what we can expect to get for this. And therefore, we're going to knock $5 billion off our forward projected goodwill on the company. Okay, so it's not a cash event. It doesn't change what they earn at all. All right, last year they lost 92, not last year, yeah, a year ago they lost 92 actual cents. These were not actual cents, these are virtual cents. They lost it on paper. Okay, so they made money. And it's a big turnaround, and it's exactly what they're trying to do. But nobody will give these guys a break at all. And you know, yeah, they're going through an incredibly rough thing where they've got a whole bunch of stuff. And not only that, but they're under huge pressure to build up their 5G, which is a whole new problem they weren't expecting a couple of years ago. Everybody's got to have the 5G now. They're in huge fiber competition with AT&T. There's all kinds of stuff happening. But on the other hand, which nobody notices, is Elizabeth Warren, all right, who may be our next president, Warren. She wants to have an $85 billion fund for public broadband. And you know who benefits from that? FTR. FTR, in rural areas, they have big, poor broadband, and it needs to be subsidized because there's certainly not enough demand to justify putting out the fiber and stuff. And FTR has been participating in government subsidy programs to do this. It's a very good revenue driver for them. And even this year, with 90-something million dollars, the revenues came from that, 90 million. And Elizabeth Warren wants to put 85 billion into it. Now, she might not get that, whatever, but even if she put 8 billion in, even if Frontier only got 10% of that, that's a nice chunk of change for them. But they're a primary provider of rural services for broadband, and if there's money to be made there, they'll end up getting a nice piece of it. So that's going on, and we did a whole. Where were my STR slides? Is this them? Yeah. All right. The bottom line is it's $2 billion in revenue. They're doing what they're supposed to do. What matters is their revenue. They have a churn of 2%. That's a little bit dangerous. Okay. You don't want to see 2% churn. But on the other hand, how unrealistic is that? 1.94. You know, it doesn't get that much lower. Every telephone company has churn. That means on an annual basis, you're losing 2% of your customers. Okay, that happens to anybody, but they're not gaining any customers. That's the problem. Their problem is it's almost all losses. Their business is shrinking every year. Now, on the other hand, so the point is, can they pay off their debts before their business shrinks away? That's the trick for the whole thing. But you know, look at the cash flow. And remember saying, oh, the cash flow is declining. It's declining, but it goes up and down. And they were just talking about how they had to spend a lot of money this quarter. They weren't really planning on spending because they're trying to catch up on the 5G stuff. But net cash providing from operating activities, $575 million in one quarter. That's $2 billion a year. Unfortunately, they have $1.4 billion of debt expenses, of debt service. So it doesn't leave them much. Look, it's outside interest. It's just the interest on the debt, $1.4 billion. So these guys have got to turn it around. All right, but their pre-earnings, $3.3 billion for the year. This is for the year. $3.3 billion for the year. They spend $1.2 billion on capital expenses, and they are unfortunately spending 1.47 on interest. So that's 2.6 something there. All right, and then they've got the pension fund, 175, and that leaves them with about $300 million of cash flow. But let's get back to the basics here. Frontier is a $100 million company. So is it worth a gamble? It's basically trading like a penny stock. And of course it's a huge gamble, but you can only lose your dollar. But if they turn this around, if they manage to get through this period, just like Sprint, and again, Sprint is not the greatest thing in the world, but they've gone through this. MCI went through it, they ended up going bankrupt. AT&T and Verizon went through it too at certain points though. When they built up, Comcast went through this. A lot of huge companies AT&T went through this at one point. You know, when they broke up and they did their whole thing. It's, you know, you go through these periods where you as a phone company have to make incredibly large investments and borrow tremendous amounts of money in order to create a system that people are then going to start paying you monthly for subscription revenues. And if you don't do that, if you don't make that investment, then you're dead. So Frontier borrowed all this money. And where's their payback chart? Well, I don't have their payback chart. So Frontier has all these debts and they've got all these obligations and they've got to pay it back. But if they do finally pay it back and they no longer have to put $1.4 billion into interest, and by the way, this is 10 years from now. Okay, but 10 years from now, if they pay off their debts and they still have half of their business, they're going to make a fortune. If they still have even a third of their business, they're going to be worth a fortune. And in 10 years from now, at the current churn rate, they're going to lose 20% of their business. If they lose more, though, now you make a negative scenario. What if the churn increases? What if they have to incur more debts? What if rates go up on their variable debts? You have to look at all that because all those what ifs mean possibly the risk is that they don't get out of debt before they go bankrupt. That's where the danger lies. Okay, so your bet is, so a lot of people aren't willing to take that chance. I like taking that chance because the payoff on this thing could be very, very substantial. This $1 stock could be a $10, $20 stock down the road. And meanwhile, it's not like they don't have business. This isn't, you know, you're not betting on a company that has no revenues. They have $3 billion, $3.5 billion in profit. That's not revenue, that's profit. It's just, unfortunately, they have to pay it all out in debt. Revenues are $8.5 billion. All right, this is what they bought. They were at 5.5, they went to 8.5. They bought $3 billion a year in revenues from Verizon for about $15 billion. They paid 5 times revenues. And they're hoping to drop it to the bottom line. What did they do? They went from 983 to 415. They added about $500 million a year in revenues, in profit. So they bought an asset that adds profit and drops to their bottom line, but they have to pay off the debt that they incurred to get there. And they're betting that that they could afford to pay off this debt. At the moment, it's incredibly rough, but they're only 2 years into it. Or this will be the third year. This will be the third year of them having to deal with this incredible debt hole. It's a 10, 15-year payoff plan. And everybody's like piling on top of them now. It's crazy. Nobody wants to give this kind of business a chance. And it's not just them, because all the telcos are like this. They're all getting treated this way. For some reason, everybody's hugely concerned about corporate debt, but when as a country we're doing the same thing, everybody thinks that's okay. I think that's pretty weird. Anyway, so they've got $700 million in the bank. Their cash flow. Here's the interesting thing about this company. So cash flow was, well, that doesn't. Wait, that's financing cash flow. Sorry, cash. Total cash flows, investing, financing. Oh, this is messy, huh? Anyway, so cash flow from operations, $1.8 billion. If they can get rid of the debt that's chewing it all up, they'll be in fantastic shape. You know, and so here's the quarterly cash, changing cash, 235. This quarter was positive though. They've got 700. Doesn't say what the cash is here. Balance sheet will say that. So for whatever reason, they said they had. Now they have 700 million in cash according to the statements that we just looked at, and if they're projecting 300 million more cash flow for the year, they'll have $1 billion. Plus, they're selling that operation for 1.3, so they'll have like $2 billion at the end of the year. Now they can use that to pay down some of their debt. And let me see if I can pull this up and Seeking Alpha. FTR. So now it becomes important when you look at it, because you got to look at the slide. Oh, that wasn't it. Ah, that was it. There you go. So they're going to finish this year with $2 billion in cash, okay? They don't need any next year to pay down debt. They have they need some 245. They need 327 the next year to pay down debt. Over the course of these 2 years, they'll have to have 2.7 to pay down this debt. But that seems like they're going to have it at the pace they're going now. If they're adding 300 billion here, and 300 million here, 300 million here, 300 million here, and 300 million here to 2 billion here, they'll be able to pay that. They'll come in here with 2+. They should have enough money to pay this off. And then in 2023, they'll probably push these out and refinance them across so it becomes a more manageable amount. Don't know what they're going to do for sure. This one's a problem, though. This is where they run into trouble here. And there's a lot of ways you look at this and say, well, how the hell are they ever going to pay that? It's $4.5 billion in unsecured debt coming after a $2.6 billion hit. They're going to have to refinance it out for another 10 years. Now, can they pay $450 million a year? Sure, of course they can. That's easy for them. But they're going to have to refinance it out. Now the question is, how much is the debt? At what price is it? But these are fixed debts. This is the only revolving. This one's revolving, and they haven't used much of it. They still have, I don't know what that now. Oh, well, you can kind of look for an appropriate size. They still have probably about $500 million left in a revolving line of credit here. But also keep in mind, these are unsecured debts. And the funny thing is, these are secured debts. These are the ones that really hurt. These guys can tell them to drop dead. These guys are in big trouble if they can't pay them. Now, unsecured debt is a sort of a signal that you can send to your shareholders saying, hey, we don't have to pay these guys. They don't have any security. If we don't pay them, we just default, and they can sue us, but they got nothing to back it up. These are the guys you really owe money to. They have secured debts. You pledge your assets to their debts. But Frontier has just showed us the assets do have value. So when you go back to their balance sheet and you say, well, look, they've got $14 billion worth of property, plants, and equipment. This goodwill is what they wrote off. They wrote off this goodwill. That doesn't change their property, plant, and equipment value. So they've got $14 billion worth of hard assets that they can sell, which means they can pay off a large portion, whoops, where to go? They can pay off a large portion of this debt with their assets. Now, of course, then they wouldn't have any assets and they wouldn't have any sales and cash flow. Somewhere in between is where they're going to be. But they can sell off $2 billion worth of assets in a pinch. But don't forget, they're upgrading their entire networks to 5G, to fiber, and so on and so forth. That's the investment that they're making. That investment in that property, plant, and equipment investment that they're putting through here is going to hopefully, they hope, is going to generate more revenues, not less revenues going forward. And that's their premise. And so if you want to invest in them, you invest in them, you've got to realize it's a freaking 10-year plan. It's not a 1-year plan. It's not a 1-quarter plan. You're going to have to ride it out and hope they don't go bankrupt. It's 50-50. They could go bankrupt or they could do well. But if they do well, you make 10 times your money. If they go bankrupt, you lose 1 time your money. So make sure it's 1 time your money that you can afford to lose. So I'm not saying, I'm not saying bet the house on it, but like I said, I'm willing to take one allocation block, 1/20th of my long-term portfolio, of my allocations of my long-term portfolio. So the long-term portfolio is much bigger now, but I'm willing to, and again, that goes back to it also. If the long-term portfolio wasn't overall successful, I wouldn't be as willing, but since we're doing so well, I'm willing to take $100,000 and put it on that because that 100,000 can turn into $1 million. So in the next 5 years, if I can make $1 million on that, then that's 20% a year for 5 years. That one little investment can make that much back to me. The worst it can do is hurt me by $100,000, by 8% of my portfolio. I'm willing to take that chance. I'm willing to risk losing 8% against winning 66% when it's a coin flip. Which one happens? Is it, would I bet the house on it? No. Is it even in our hedge fund? No, our hedge fund doesn't make those kind of trades. That's too risky for the hedge fund. But it's a very interesting trade. And if you have a portfolio where you can afford to lose the money, why not? Sandra says, wait longer for new trades. Well, we're waiting because we want to see how the indexes resolve themselves. And we aren't going to know that until we see which way they break out in those boxes. And FTR took their savings projections down from almost half as well. Yeah, FTR took their savings projections down because they're spending more than they thought on 5G and fiber because they're in a race to get there. And it's costing them more than they thought it was going to cost, but they're going to get there faster too. Therefore, the profits will accelerate down the road, but it's too far away for them to talk about it. So, and again, I'm not going to sit here and fight for it. It is a literal coin flip whether they go bankrupt or not. If they don't go bankrupt, though, it's probably going to be a real, very big winner. So it's a risk I'm willing to take. But as I said, it's not a risk I'd be willing to take in a hedge fund. It's not a risk I would take with other people's money. But with a portfolio that's up 160% in 18 months, I don't mind risking some of that. That's fun money for us. We can play with that. But it's not a major bet I would put in a portfolio. It's nothing I would bet the house on or anything like that. It's just a fun bet to have. In fact, at this level, now that they're down to $1, my kids are going to buy it. Because my kids, in my kids' funds, I usually buy penny stocks. And this is now becoming in that range. In fact, when $1 options come out, I will then buy FTR because I will buy the FTR stock. I will sell calls and I will sell puts. The net cost will be 0, and if it gets assigned to us, it'll be about 50 cents. But I have to wait for the $1 puts and calls to come out before we do that. All right. Wow, look at that. I was going to end early, and now we're ending late. Okay. Well, thank you, everybody. Oh, wait. Somebody says Pfizer. How did that come up there? Sorry, I missed that. Pfizer looking interesting. Any thoughts on position? Wait a second. I didn't see that before. Okay, Pfizer. I don't know, are they low enough yet? Have they sold off enough to be interesting? Pfizer is also a really good one though. Generally, I like them. I do like them when they're cheap. $30, I think, is where I like to buy them. No, they're not 30 yet. No, they haven't been 30 in a long time, though, have they? Oh, yes, they have. Well, so they're 36 here. Yeah, if they were down around 32, I'd be excited. I'm not excited yet, but they'd certainly watch them. If they come back down to 32, absolutely, 11 long term. They are reasonably priced at 36, but they're not a bargain. They're only a bargain, and that's, by the way, the big danger of this kind of investing in a declining market is a lot of things look like bargains, but it was ridiculous at 42. In a million years, I wouldn't buy Pfizer at 40 bucks. That's too much. There's an inherent risk to these stocks, as you can see from Johnson & Johnson and stuff like that. You can't, just because something was ridiculously priced and now is reasonably priced, doesn't mean you should jump all over. Wait till it's ridiculously cheap. In this market, there's going to be a lot of things that are ridiculously cheap. So I like Pfizer. I like them because they pay a big dividend. I like them because they're a steady company. They're all over the place. But 36, not that cheap. 32, okay, then I can construct a trade. But 36 is still a bit much for me. All right, guys, thank you very much for listening, and we're going to wrap it up now, and we'll do it all again next week. Am I going to do it next week? Yes, I am. That's right. I'll be back. I'm going away for the weekend, but I'll be back by Wednesday. All right. I'll be back on Monday night. All right, guys, so thanks very much, and we'll see you later. Bye.